Good evening, I'm John Barton, and welcome again to Business Week. The past week's news has been dominated by reshuffling in the media industry. On Monday, the investment arm of the shopping centre conglomerate, Westfield, dramatically lifted its television interests, buying the Channel 10s in Sydney and Melbourne for $842 million. As the shockwaves reverberated around the country, in Sydney, a Senate committee began hearings on regional television. While on the share market, Northern Star Holdings, partly owned by Westfield, is emerging as a rising star. Brian Frith will have all the developments later in the program. Over the last 2 years, booming share markets have attracted many punters, making brokers feel like bookmakers at the track. Well, now, one of Australia's greatest racehorse trainers and buyers, Tommy Smith, plans to combine his horses and the share market with the public float of his stable, Tulloch Lodge. Tonight, we look at the $20 billion racing industry and the floating of a public racing company.
It'll be one of the greatest things ever happened because I'll be buying more horses and better type of horses.
Tommy Smith's company is the first of its type in an industry that can be lucrative for the brave and wealthy, but for the small player, it's very risky.
Just remember that today you might have a champion, tomorrow you've got nothing.
The Horse Float, a report from Nigel McCarthy on the listing of shares in a company owned by one of the country's greatest trainers, Tommy Smith. Also tonight, the best trans-Tasman corporate performer for 20 years, Ron Briley. Investors who originally bought into his companies for a few £1,000s are now multi-millionaires, and the growth is not expected to stop, as Briley's industrial equity is taking on the world. Then, an exclusive profile of yet another Western Australian entrepreneur, Laurie Wilson, who's made his fortune from car parking.
I have certainly put my heart and soul into my business career, but I've done that at a balance to my family life. And I think it's that balance, that necessity for me to balance my family life with my business life that has prevented me from being a Bond or a Holmes Accord. But at the same time, I have, in my opinion, been ultra successful.
Laurie Wilson is now expanding into the entertainment industry, and he plans to bring a collection of the world's greatest performers to Australia.
Well, we sensed it and, as a very, very exciting industry to be in. First of all, it's terribly fragmented, and as a result, we believe we can coordinate the industry and make a very, very highly successful public company out of being in this industry.
Parking Zone, a profile of a man who's taken car parking across Asia and now looks set to drive into entertainment. A report from John Hosking. We'll also update 2 recent stories on the Bank of America and the battle for the mineral water market. All that will come when Business Week returns after the break. And you're watching Business Week. One of the world's greatest corporate players, Ron Briley, tells us where he sees the share market going later in the program. But first, the horse float. Tommy Smith hits the stock market boards after more than 30 years as one of the country's top racehorse trainers. The racing industry is a playground for the rich and famous, for prime ministers to top business people. The cost of buying and keeping a racehorse has always meant that only the rich could afford to be owners. But Tommy Smith claims he has a way for small players to get into the sport of kings.
The good oil, inside information, a hot tip from the horse's mouth, stable talk. Call it what you will, the racing industry thrives on it, and there's always plenty for the strappers, jockeys and trainers to think and talk about. Yearling sales, how the horses are running, what the opposition's plans are. In recent weeks, the talk has been about something new. TJ Smith is floating a company to buy and train racehorses.
It'll be one of the greatest things ever happened because I'll be buying more horses and better type of horses. And it'll give the people a great chance to have interest in horses. When they run in the barrier trial, and we haven't, like we did last year, won 7 or 8 barrier trials, I'm going to sell shares in the horses straight away. If anyone wants to have an interest in a horse, they can come along.
Tommy Smith looms large in an industry that is Australia's 3rd biggest. The turnover exceeds $20 billion a year. There are 35,000 racehorses in Australia chasing $106 million prize money. That amount, split between all those horses, gives average winnings of $3,000 a year. Training, with feed and stabling costs included, runs to $10,000 or $15,000 annually.
When they say that racing is the sport of kings, it is not only a sport, but only kings or millionaires can afford it, and they have to go into it with the attitude, that if they lose money, that's part and parcel of the game. If they break square, that's a bonus. And if they make money out of it all, well, that's manna from heaven.
Arthur Harris advised Stan Fox, through the 70s, one of Australia's biggest private owners. Harris also helped the Legal Eagles, a lawyers' betting syndicate that made money punting on races across Australia. His view of investing in a trainer's company...
I wouldn't be putting my money in it.
That reaction, because in the racing game, it's not only the punter who's taking a risk. The gamble isn't only in here. From breeding to the winning post, the risks are almost countless. And for the trainer, or any would-be investor in a training company, they start at the annual yearling sales.
Dan was a great man, placed the road hill.
And prices at the yearling sales are soaring. A recent New Zealand auction saw an average price of over $100,000 a horse, representing an increase of 39% over the previous year. Figures like that make forming a company and having a big bankroll attractive. Tommy Smith has already announced guarantees of $16 million worth of shares for his Tulloch Lodge company, named after his base at Randwick. But prize money isn't keeping pace with sale prices. Despite an increasing number of million-dollar purses, prize money is only growing by 16%, and the chances of picking a winner still slim.
Out of all the yearlings that have been bought in Australasia in a year, which is a very big number, only 40% of them make it to a racetrack. About 30% win a race, and about 20-odd% win a race in town or more, and then about 10 to 12% win group races, which are black type races.
The bookies, the men who make a living calculating the odds more accurately than the punters, are early arrivals at every race meet. But as if the risk and chance of racing were not enough, from day one, from the yearling sales, investors can face other hurdles.
These are auctions, and they're conducted in Sydney, Melbourne, Brisbane and New Zealand. Usually the yearlings are auctioned, horses at 1 year old, and they're brought in. They haven't been tested, nobody knows how good they are, and people bid on their pedigree and their conformation, to hoping to buy a champion.
TJ Smith is unequalled in picking which horses will go into the barrier and cover the distance fastest. For 33 years, until Brian Mayfield Smith beat him last year, Tommy Smith was Australia's premier trainer.
1982, and Tommy Smith in New Zealand and Australia that year had some 40-odd yearlings knocked down to his name for a capital outlay of $1.8 million. Now, he did a very good job, because of those horses, 47% won a race in the metropolitan area. Now, that means Tommy Smith has got some sort of a genius and a good eye for a yearling. But to return to the finances, they cost $1.8 million. To have them trained would cost at least another $1 million, so you're up now for $2.8 million. Those horses, over 4 years of racing, that is, through the 83, 84, 85 and 86 season, collectively won $1.1 million in prize money. Out of those 40 horses, one very, very good horse was selected called Alibi, who won $668,000 in prize money and was syndicated as a stallion for $1 million. So that the return now to the owners is $1.9 million. Now, that was a very good year. 47% strike rate of winners, a champion, and the receipts back are $1.9 million out of a total outlay of $2.8.
Tulloch Lodge Limited will look like this. The issue, 30 million shares at 40 cents each, with a premium of 10 cents, for a total capital and reserve of $15 million. The company holds an option to acquire the horse training and bloodstock activities of Tommy Smith, including goodwill. Payment to Smith will total $2.245 million. $2.145 million of that will be for goodwill. Smith will stay with the company as joint managing director for 5 years. Salary $150,000 a year, with a bonus of $35,000 for every $1 million profit. Tulloch Lodge Limited will lease the Kensington base, stables in Melbourne and Brisbane, and has an option to buy 3 rural properties previously owned by Smith's fellow managing director, William Manning. Other directors are lawyer Jim Beattie, vet John Peatfield and Brian Newell. The principal source of income will be from agistment and pre-training charges, training fees, prize money and short-term investment of unused capital. Yearlings worth $3.185 million were purchased last month on behalf of the company. Directors say in the prospectus, to be launched tomorrow, that because bloodstock will be purchased in the main at yearling sales, evaluation and assessment of initial purchases is likely to take at least 18 to 24 months. Consequently, income from bloodstock trading in the first 2 years is likely to be minimal.
If it goes and people follow, it pours a lot more interest and money into the racing game, which could only do the racing game good. But the end result of whether it really does do the racing game good is if it's successful, and you won't know that till about 2 or 3 years down the track.
In his late 60s, Tommy Smith is doing something new in racing, perhaps starting a trend. Some aspects of his move still to be made clear.
You as an investor have bought shares, and with the money that you've paid for shares, Tulloch Lodge has purchased certain horses, and now the horses are ready to win. Are you as a shareholder in Tulloch Lodge and in the horses entitled to know whether your horse is going to win on a particular day? I would say that you should be entitled to that information.
Do you see that happening though?
Well, I can see that there's going to be a lot of practical difficulties on that, because how could you, for instance, if there were thousands of shareholders, how could you contact every one of them on race morning to let them know that their horse was primed up and ready to win? It'd be very hard.
Gamblers putting their money through the bookies and the tab, or investors taking the plunge on the stock exchange. Racing, it would seem, will always remain the four-legged lottery.
When you get into a venture which is involved in racing, just remember that today you might have a champion, tomorrow you've got nothing. And that's by virtue of the fact of injury or anything like that. So that's, I think, for the unwary, that is something you should really consider before you get into it.
The horse float. Tommy Smith punts on a new direction for his Tulloch Lodge. That report from Nigel McCarthy. After the break, Industrial Equities Chairman Ron Briley talks about his plans for growth and his predictions on where the Australian share market and economy are heading. Tens of thousands of Australian and New Zealand investors have made their fortunes by investing in Ron Briley's companies, which have been showing exponential growth in earnings for 20 years. That growth has been produced by diversification and astute share market plays. Tonight, Ron Briley joins me in the studio. Thanks for joining us. Mr. Briley, if I could ask you, first of all, the intense buying of media stocks in recent months has seen the share market overheat in this country. In the absence of that buying, what do you see, or how do you see the market performing?
Well, I think the market would have been fairly buoyant. Share markets around the world have been, and the Australian market was pretty firm even before the media activity. But certainly the media activity's given it added emphasis.
Because of that, though, it would appear to be a false set of circumstances, because we're not likely to see intense media buying in the coming months, are we?
No, we're not, John, and that's one of the reasons for it. We're not likely to see it in coming months or possibly ever again, and that's why there has been so much intensity in all of the buying and selling, because most of those who wished to be involved realised that it was a last opportunity, and they were taking a strategic decision for many years ahead.
Are we looking out there for a fairly severe contraction in the share market?
I wouldn't say that, because there's a lot of money washing around now as a result of some of these transactions. But markets they're historically very buoyant, and it can't last forever. There'll be some reaction at some stage, but that's of course the whole secret of any share market investment. It's simply timing.
It's pretty hard to predict, isn't it? But if I could ask you, could you put a time frame on a contraction, and could you tell us in which area of the market do you think it's going to contract?
Well, I've already said in respect to New Zealand that 1987 will be a crunch year for many of the newer companies, and I think the same applies to the Australian market as well. So I see this being a very interesting year in terms of a new set of circumstances, probably after all the media activity dies down.
Are we looking at a crash of some sort?
I wouldn't say crash, John, but shares don't go up forever. They never have and they never will.
While we're talking about the media and the intense share market activity, do you think the buyers of Channels 9 and in Melbourne and Sydney, of the Herald Weekly Times and the Melbourne television station HSV, do you think those prices are extraordinary, too much?
Well, they're very, very high prices by my standards, John. I'm an old conservative, so perhaps I tend to put lower values on them anyway, but they're very, very full prices, and I can only assume, as I said before, that the buyers are looking not just 1 or 2 years ahead, but they must be looking decades ahead.
Can you look decades ahead in that sense?
Well, I sometimes wonder about the practicality of doing so. It'll be very interesting to see how those capital values can be justified in terms of performance of the public companies that now own them.
If you had paid those sorts of figures, could you justify them in your business?
That's a bit of a hypothetical question, John, but I feel we'd be struggling to do so.
Let me ask you about your 19% stake in advertiser newspapers. Why have you bought in there?
Well, I suppose the easy answer, John, is that we bought in because we think it's a good investment. But you will recall that we had a substantial investment in Herald and Weekly Times, which arguably may have been the catalyst for all of this activity. We sold those shares and we purchased advertiser shares, and I think that in all the activity that's taken place, advertiser has been the neglected company. It's a good, solid, conservative company, and I just simply think it's been neglected. I think our timing was probably right in that if we hadn't bought 20%, I think somebody else would have. But as a consequence of our buying, it's really frozen out any other potential major shareholders.
Do you plan to increase that stake?
Well, John, 20% is as far as we can go, so we're almost there now.
Just to finish up on the media questions, the Fairfax Group, how vulnerable is it to a raider like Holmes à Court?
Well, I don't think it's vulnerable at all, John. I mean, the facts are well known. It's a strongly family shareholder-oriented company, and I wouldn't think it's vulnerable at all in that respect.
Turning to IEL, with things not looking terribly optimistic in this country and in New Zealand, do you see IEL's future more overseas?
Well, when you say not too optimistic in this country and in New Zealand, I don't know that I'd agree with that, because I've said, and I still say, that for us anyway, there are plenty of opportunities in New Zealand and Australia. In our own case, we've expanded overseas simply because we have the resources and the people and the experience to do so. It's a natural progression so far as we're concerned, and I see our development in Australia and New Zealand taking place on an equal basis with our overseas activities.
You're somewhat at odds with businessmen like John Elliott, who says there are greater opportunities for Australian companies, and I would take from that New Zealand companies as well overseas.
Well, there are lots of shades of meaning in John's statement, whether he intends there to be. Yes, there are greater opportunities because there's just so much more there. The companies are just so much larger. So physically, yes, there are greater opportunities, but I doubt if he means, and I certainly don't agree, that that means there are no opportunities here, that there are plenty of them.
What's going to happen to your local operations if you continue to expand overseas as you are?
I think they give added strength to each other, and I certainly don't see an Australian or New Zealand company existing simply on overseas expansion. Equally, I think it would be a very restricted view not to look further afield, and I see, as I say, I see without any particular deliberate effort, I just see a natural growth being more or less equally New Zealand, Australia, UK, USA.
You say there are plenty of opportunities in New Zealand and Australia. In what particular areas?
Well, we are involved in mergers, reconstructions, industry rationalisation. I said before that statistically there are less opportunities. That doesn't mean to say that you can't make your own opportunity, and we certainly intend to do so.
You've got other projects you're looking at the
Definitely,
moment.
John.
With that in mind, I wonder whether the $6 billion merger of Briley Investments and IEL, which you called off last year, is going to take place this year.
Well, if the conditions were right, it would certainly be a sensible move. I think it would have certain advantages. On the other hand, if it doesn't take place, they're two quite strong companies in their own right. We'll simply carry on as usual.
Are you looking at merging those two this year, though? Do you have is there another approach in mind that you have?
Well, with the present political and tax background, a merger is not a practical proposition. And what I'm saying is that not only applies to us, but it applies to the market generally. And in my view, that's not a good thing. And I'm simply waiting till this view becomes more widely apparent.
Let's talk about Woolworths and your stake in Woolies. There are some say you've paid too much for that acquisition, especially when you consider their latest profit performances. How would you answer those people?
Well, those people, whoever they are, John, there's always someone that says we've paid too much, and it's always a little daunting because there's no absolutely finite answer to whether you've paid too much or not enough. I think it's fair to say we've paid a fairly full price for our shares in Woolworths, which is obviously having a bad run, but equally it's a very strategic stake. We've identified with Woolworths for the longer term, and I think whether we've paid a little too much or not, that'll all wash out in future years.
How difficult is it going to be to get it back on the rails into a fairly healthy profit situation?
I just don't know, John. I have no doubt there will be difficulties, but I have no doubt also that the company has a number of strengths which we will seek to enhance.
How do you see Rainbow Corporation's investment in the same company?
Well, they've made an investment. What their ideas are, I don't know. It's very difficult for me to speak on their behalf.
Just to finish up on a personal sense, you've been involved in these companies for well over 20 years. Do you plan to scale down your interest in these activities?
Well, I don't really, John, because as the companies grow bigger, the scale of activities is equally larger. I think it's a matter of a changing role as we involve more and more people and the scope goes wider.
You don't have any political aspirations at all?
None at all, John.
Just following the cricket team. Mr. Briley, thanks for joining us.
John.
That was Ron Briley, the chairman of Industrial Equity. And next on Business Week, an exclusive profile on one of Western Australia's most successful sons, Laurie Wilson.